So imagine you own this massively successful private company, right? And you decide to take a huge loan out of the company's bank account to buy yourself a luxury villa. You have to pay that money back because it's a loan.
Yeah, you would think so.
Right. But actually, no. The taxman might look at that exact transaction, completely ignore the word loan on all your paperwork, call it a deemed dividend, and just hit you with a massive tax bill right there on the spot.
Exactly.
Because in the world of taxation, things are, well, they're rarely what they seem on the surface. You've shared your study notes with us today, specifically for the NIM Series XB certification. And we are going to do a deep dive into the government's miscellaneous drawer, Chapter 9 of your official text, which is income from other sources.
And we really aren't just going to, skim the surface of your study material here. To truly prepare you for this certification, we need to understand the actual architectural logic of the Indian tax code. We are going to dissect every single list, break down the historical context of the formulas, and figure out exactly why the government categorizes income the way it does.
Yeah.
Because, if you understand the why, the what just becomes incredibly easy to remember on exam day.
That is exactly what we need, because reading the raw textbook can feel like, I don't know, trying to memorize a dictionary.
It really can.
So let's establish the foundational landscape first. The Indian tax code basically separates all income into 5 distinct heads, or buckets. If you earn a paycheck, that goes into salary.
Right.
If you rent out an apartment, that's income from house property. If you run a shop or maybe practice law, that goes into profits and gains from business or profession. And if you sell an asset like land or shares at a profit, that gets dropped into capital gains.
Exactly. Those 4 are highly structured.
Yeah, they make sense. But then we arrive at this 5th bucket. The text officially calls it the residuary head of income.
Yeah. And residuary simply implies what is left over. Yeah. The remainder. I mean, the logic here is completely chronological. The income tax department effectively runs your earnings through a gauntlet of those first 4 categories.
Oh, a gauntlet. I like that.
Right. So if your income survives that gauntlet, meaning if it cannot logically be classified as salary, house property, business profit, or capital gain, it drops straight into this 5th catch-all bucket. It's essentially the default destination for any uncategorized wealth generation.
I was actually trying to conceptualize this, and it feels exactly like the miscellaneous drawer in a kitchen. You know the one?
Oh, absolutely.
You opened it up, and there's just a random assortment of like AA batteries, some super glue, a spare car key, maybe a warranty card for a blender you don't even own anymore.
Yeah, that's a perfect analogy.
Everything in that drawer has value, it's all important, but none of it belongs with the silverware or the spices.
It's a highly accurate way to visualize it. However, the trap many students fall into is assuming that just because it's a miscellaneous drawer, it's some sort of unregulated free-for-all.
Right, like they don't care about it.
Exactly. But that couldn't be further from the truth. The taxman's miscellaneous drawer has incredibly strict, highly litigated rules. The income tax department has meticulously cataloged what goes in, how its value is calculated, and the precise moment it triggers a tax liability.
Okay, so before we get into the complex financial instruments, the stocks and the bonds, we need to map out exactly what is sitting in this drawer. Section 9.1 of the text provides a table of 14 specific pillars of other sources. Let's not just read them out, though. Let's actually figure out what they look like in the real world.
That is definitely the best approach.
Yeah.
So looking at the official list, the very first item is dividend income. This is really the cornerstone of the chapter for any financial professional.
Makes sense.
And the text makes a point to explicitly include buyback proceeds here as well-meaning money received by a shareholder from a company buying back its own shares.
Right.
We will do a massive deep dive on the mechanics of that later on, but for now, just know dividends and buybacks are item number 1.
Okay, so they don't fit perfectly into capital gains because you aren't selling on the open market, and they aren't business income for a retail investor.
Exactly.
What's the second item?
Number 2 is essentially the luck category. Winnings from lotteries, crossword puzzles, races, including horse races, card games, and other games of any sort.
So basically gambling and windfalls. If I go to a casino or buy a scratch-off ticket and win, it drops into this bucket.
Bingo.
But wait, why is there a distinction between this and the next item? Because looking at the text, number 3 on the list is winnings from online games. Why did online games need their own separate line item if we already have a category for games of any sort?
That is a very astute observation, and it really points to how tax law evolves alongside technology. Historically, the line between a game of skill and a game of chance was fiercely debated in Indian courts, especially with the explosion of platforms like Dream 11 or online rummy.
Oh yeah, the fantasy sports boom.
Right. So by creating a distinct, explicit category for winnings from online games, the government effectively closed the loop. They established a specific taxation framework which often involves heavy tax deduction at source, or TDS, that applies specifically to the digital gaming ecosystem. It bypasses the older, clunkier regulations meant for physical horse tracks or paper lotteries.
Ah, so it's the government adapting to the digital economy. That makes perfect sense. Okay, number 4 is interest on securities. We'll tear that apart later as well.
Yes, we will.
But number 5 is where the list gets a little confusing for me. It says rental income of machinery, plant, or furniture. Now, if I am renting out heavy machinery, how is that not just a business?
Well, it absolutely can be a business. And this is a recurring theme you're going to see in this chapter. The text includes a crucial caveat for this specific item. It states that this rental income falls under other sources only if such income is not chargeable to income tax under the head profits and gains of business or profession.
So it's all about the primary intent of the taxpayer.
Precisely. Let's say you own a massive construction firm. Your entire business model is leasing out excavators and cranes. That is definitively business income.
Right.
But now imagine a completely different scenario. You own a small IT consulting firm. You bought a high-end commercial-grade backup generator for your office. It just sits unused most of the time. Then the restaurant next door loses power, and you agree to rent them your generator for a week for a substantial fee.
Okay, I see.
Renting out generators is not your profession. It's a one-off exploitation of an asset you happen to own. Therefore, that specific rental income drops into the miscellaneous drawer.
That is a great distinction, the primary business versus the opportunistic side hustle. And just to clarify tax jargon quickly, when the text says plant, it's not talking about a botanical garden, right?
Correct. No, in taxation, plant broadly refers to the apparatus, equipment, or machinery used by a business to carry on its operations. It could be a printing press, a fleet of vehicles, or even specialized software systems, depending on the exact context.
Good to know. Let's look at number 6 then, composite rental income. The text describes this as letting out plant, machinery, or furniture along with a building, where the letting out of the building is inseparable from the letting out of the equipment. Again, with the caveat that it's not taxable under business.
Yes.
But what does inseparable actually mean here?
Think about a fully operational specialized facility. Imagine you own a state-of-the-art cold storage warehouse. It's not just an empty shed, right? The walls are lined with specialized industrial refrigeration units, the wiring is custom, the shelving is fully integrated.
Oh, yeah?
If you lease that out to a pharmaceutical company to store vaccines, you are charging them a single composite rent.
Right. I'm not charging them $50,000 for the building and then another $50,000 for the fridges. I'm charging $100,000 for a cold storage facility.
Exactly. The letting of the building is completely inseparable from the letting of the machinery. You can't just take the fridges out without destroying the core utility of the building. So if you are doing this as a one-off and not as your main business operation, the entire composite rent falls under other sources.
Oh, I see.
The government doesn't want you artificially splitting the rent to claim different types of deductions under the house property head versus the business head.
They really have thought of every loophole, haven't they?
They try to.
Okay, number 7 is sum received under a Keyman insurance policy, including any bonus. I definitely need a definition here. What exactly is a Keyman insurance policy?
So a Keyman insurance policy is a life insurance policy taken out by a business on the life of an employee whose services contribute substantially to the success of the business.
Like a CEO.
Exactly. Think of a visionary founder, a brilliant lead scientist, or a top-performing sales director. If that person suddenly passes away, the business would suffer a massive financial shock. So the company pays the premiums to insure their life, and the company is the beneficiary.
Okay, but if the company is paying the premiums and the company gets the payout, wouldn't that just be business income when the insurance actually pays out?
You are following the logic perfectly. If the company receives the payout, it is generally taxed as business income. But what if the company assigns that policy over to the Keyman himself upon his retirement? Or what if the payout goes to a third-party investor who bought the rights to the policy?
Oh, wow.
Right. If the sum received does not neatly fit into salaries for the employee or business income for the company, the tax code catches it right here in other sources. It basically ensures that no matter who receives the massive payout from this corporate policy, the taxman gets their share.
The gauntlet catches everything. Moving on to number 8, interest on compensation or enhanced compensation. What kind of compensation are we talking about here?
The most common real-world example in India involves the compulsory acquisition of land. Let's say the government decides to build a new highway right through a farm you own. They exercise eminent domain, acquire your land, and agree to pay you compensation of, say, 1 crore rupees.
Okay, so that 1 crore would be capital gains because I effectively sold the land even if it was forced.
Exactly right. But government processes are notoriously slow. Let's say it takes them 5 full years to actually hand over that 1 crore. By law, they have to pay you interest for those 5 years of delay.
Right.
That interest component is not a capital gain. I mean, the land didn't appreciate it. It's just a penalty for late payment. So that interest on the delayed compensation drops into other sources.
I see. The principal is capital gains. The delay penalty is other sources. That brings us to number 9, which is a bit of a mouthful. Advance money received in the course of negotiations for transfer of a capital asset, which has been forfeited, and the negotiations do not result in the transfer of such capital asset. I get the words, but walk me through the human element of this transaction.
This happens in real estate all the time. Imagine you own a luxury flat in Mumbai and you want to sell it. I come to view it, I absolutely love it, and we agree on a total sale price of 2 crores. To lock down the deal and take the flat off the market, we sign an agreement and I transfer a token advance of 20 lakh rupees into your bank account.
Right, the earnest money.
Exactly. We agree that the remaining 1.8 crores will be paid in 60 days. But during those 60 days, my business takes a hit, my bank denies the mortgage, and I have to call you and back out of the deal. According to the penalty clause in our contract, because I broke the agreement, you get to forfeit my advance. You keep the 20 lakh rupees.
Okay, so I still own my flat, but now I'm magically 20 lakhs richer.
Bingo. You didn't transfer the capital asset, so it cannot be categorized as a capital gain, but your net wealth just increased by 20 lakhs through a failed negotiation.
Wow.
The government views that as a clear accretion of wealth, and since it doesn't fit anywhere else, that forfeited advance money is shoved directly into the income from other sources drawer.
That makes total sense. It prevents people from running fake failed transactions just to transfer money tax-free. Item 10 is deemed income in certain cases, specified under Section 562. Now, I know from reading ahead that this heavily involves gifts, which we have a massive section dedicated to later, so we will bookmark that for now.
Good idea.
Item 11, compensation on termination of employment or modification of terms of employment. Why isn't this just categorized as salary?
It often is. But sometimes the nature of the compensation falls outside the strict employer-employee relationship definitions required for the salary head. For instance, if you receive a payment from someone other than your employer in connection with your termination, or if the payment relates to modifying the terms of a future contract before the employment formally begins.
Right, I see.
The tax code puts it here to ensure that any golden parachute or modification fee doesn't slip through the cracks just because the legal definition of employee wasn't perfectly met at the exact moment of payment.
The ultimate safety net. Item 12. Sum received under a life insurance policy other than ULIP and Keyman in excess of the aggregate premium paid during the policy term. This feels like a pushback against using insurance strictly as an investment.
That is exactly what it is. For decades, life insurance in India was sold more as a tax-free investment vehicle than actual mortality protection. People would pay massive premiums for policies with very little actual life cover just to get a tax-free lump sum at maturity.
Oh, wow.
Recent changes to the tax code aggressively targeted this.
Yeah.
Now, if the policy is essentially just a disguised investment where the payout exceeds the aggregate premiums paid, and it doesn't meet specific exemption criteria that excess amount is treated as income from other sources, it levels the playing field between insurance products and traditional investments like mutual funds.
That definitely makes the tax code a lot fairer to the broader financial industry. Okay, we are almost at the end of the list. Item 13. Specified sum received by a unit holder from a business trust.
To understand this, you need to know that a business trust, in this context, usually refers to a real estate investment trust, a REIT, or an infrastructure investment trust, an INVIT. These trusts pool money from investors to buy income-generating properties or toll roads.
Right, so they collect rent or tolls and pass them back to the investors.
Yes, and that pass-through income is very complex. The text explicitly notes that this specified sum category excludes interest, dividend, or rental income from REITs because those specific streams have their own distinct pass-through tax treatments.
Okay, so what is it catching?
This line item is specifically catching other distributions from the trust, often related to the repayment of debt, or other capital distributions that don't fit the standard definitions. It's a highly specialized niche, but it's vital for anyone analyzing REIT cash flows.
And finally, item 14, the ultimate granddaddy catch-all clause at the bottom of the catch-all bucket. Any other income not taxable under any other head.
Exactly. If tomorrow someone invents a completely new way to make money that the government has never seen before, they don't have to rewrite the entire tax code to tax it. Item 14 catches it instantly.
So if I sit down to file my taxes and I have a mix of these things, maybe I won a little money on Dream 11, I kept an advance on a failed real estate deal, and I earned some interest on a bond, how do I actually compute what I owe? Do I just add up the gross amounts and multiply by my tax bracket?
Not quite. The philosophy of the Income Tax Act is generally to tax net income, not gross receipts. I want you to visualize a very simple old-school accounting ledger. Imagine writing a top-line figure. That figure is the sum total of all 14 of these gross incomes added together. Right below that, you draw a line and write less. Attributable expenses.
Attributable meaning there's a direct causal link, like I spent money specifically to make that miscellaneous money.
Exactly. You are allowed to subtract the legitimate costs incurred wholly and exclusively to earn that specific income. For example, if you earned interest on securities, but you had to pay a bank fee to process the collection of that interest, you can deduct the bank fee. You draw a final line under those deductions, and the resulting number is your true taxable income from other sources.
But I'm guessing I can't deduct my internet bill just because I used the internet to play Dream 11?
Absolutely not. The link must be direct, provable, and wholly for the purpose of earning that income. And importantly, the text points out that for certain things like lottery winnings, no deductions for expenses are allowed at all. The gross winnings are taxed flat.
Good to know. Now, looking at this massive list of 14 items, it's a lot to memorize. If I'm writing the exam, what are the trapdoors here?
Well, if I'm an examiner looking to trick a student, I am focusing on the distinction between items that are conditionally other sources versus items that are unconditionally other sources. Remember how renting machinery is only here if it's not a business?
Yes, the primary intent caveat.
Right. The official text explicitly highlights 5 specific items from this list that are always, without exception, chargeable to tax under the head other sources. They do not have that business exception. You must burn these 5 into your memory. Flag this for the exam.
Okay, I'm ready. What are the unconditionally miscellaneous items?
First, dividend income from securities.
Yeah.
Even if you are a full-time day trader, the dividends those stocks pay go here.
Okay.
Second, interest income from securities held as an investment. Third, advance money received in the course of negotiations for transfer of a capital asset which has been forfeited.
Right, the real estate example.
Fourth, deemed income in certain cases specified under Section 5662, the gift rules. And fifth, specified sum received by a unit holder from a business trust.
So dividends, investment interest, forfeited advances, gifts, and business trust sums. Those 5 bypass the gauntlet and go straight to the miscellaneous drawer every single time.
Spot on. And if you look at that priority list, the very first item is dividend income. For anyone studying the NISM Series XB, or frankly anyone investing a single rupee in the Indian stock market, this is the most critical and common encounter with the other sources head. We really need to transition from the broad list and dive deep into Section 9.2, dividend income.
I agree entirely. Let's isolate dividends. To start at the very beginning, how does the textbook technically define a dividend? We all know it's a payout, but what's the legal phrasing?
The standard, plain English definition is straightforward. Dividend usually refers to the distribution of profits by a company to its shareholders. The company generates a surplus from its operations, and the board of directors decides to hand a portion of that cash directly back to the people who hold the equity.
That's the clean, visible mechanism. But you open this whole discussion with a wild scenario about a founder taking a loan to buy a villa. Clearly, companies trying to get creative to distribute profits without using the D word, right? To save the shareholders from paying tax on it.
They absolutely do. Or rather, they used to, until the tax code caught up with them. The Income Tax Act anticipated these workarounds, which brings us to the crucial concept of the deemed dividend under Section 222. The underlying philosophy of this section is the substance over form doctrine.
Substance over form.
Right. The law basically states, we don't care what label your accountant put on the transaction. If the economic substance of the action is a distribution of accumulated profits, we're going to deem it to be a dividend, and we will tax it accordingly.
So it's a massive anti-abuse mechanism.
Yes.
The text lays out 6 specific conditions where a receipt is treated as a deemed dividend. Let's walk through them. What is Condition A?
Condition A targets the distribution of accumulated profits to shareholders, entailing the release of the company's assets.
Releasing assets. You mean instead of giving cash, the company gives the shareholder a company car or a piece of real estate it owns?
Exactly. If the company bought a piece of land with its profits and then just transfers the title of that land to the shareholder for free, the company can't argue, well, we didn't pay a cash dividend. The taxman says, you released a company asset that was funded by accumulated profits. That is a deemed dividend equal to the value of the asset.
That makes sense. What is Condition B?
Condition B covers the distribution of debentures, debenture stock, or deposit certificates to shareholders out of the accumulated profits, and the issue of bonus shares to preference shareholders out of accumulated profits.
Wait, let me break that down. A debenture is basically an IOU. So the company is saying, we have profits, but we aren't giving you cash today. We are giving you a certificate that says we owe you cash in the future. And the tax department says, nice try. We're taxing you on that IOU right now.
You've nailed the logic. They are taxing the creation of the debt obligation if it's backed by profits. And notice this second half, issuing bonus shares to preference shareholders.
Oh, why is that different?
Well, equity shareholders getting bonus shares is generally fine. It's just a stock split, essentially. But preference shareholders have fixed rights. Giving them bonus shares fundamentally alters the profit distribution mechanism, so it triggers the deemed dividend rule.
The nuances are incredible. Condition C.
Condition C is the distribution to shareholders of the company on its liquidation out of accumulated profits. If a company winds up operations and shuts down, whatever cash is left over after paying debts is handed back to the shareholders.
Right.
The portion of that cash that represents past accumulated profits, profits that were never paid out as dividends while the company was alive, is taxed as a deemed dividend right at the end.
Because otherwise, a company could just hoard cash for 20 years, never pay dividends, shut down, and pass the cash back as a capital return, completely bypassing dividend taxes.
Precisely. It closes the liquidation loophole. Condition D is very similar in spirit. Distribution to shareholders out of accumulated profits on the reduction of its capital by the company.
So instead of fully shutting down, the company just shrinks its capital base. It says, we don't need this much money to run anymore, let's give some back. If that money includes hoarded profits, it's a deemed dividend.
Correct. Now we arrive at Condition E. This is the scenario I teased at the very beginning of the deep dive, and it is easily the most heavily litigated and tested aspect of Section 222. It involves any loan or advance by a closely held company to its shareholder out of accumulated profits.
Okay, let's expand on the startup founder example. Define closely held first. Are we talking about a public company like Reliance or TCS?
No. A closely held company is typically a private limited company where the shares are not substantially held by the public. Think of a family business, a boutique consulting firm, or a tech startup where 2 or 3 founders hold 90% of the equity. The key feature is that a small group of people have total control over the company's checkbook.
Okay, so I'm one of those founders. The company has 10 crores of profit sitting in its current account. I want to buy a 5 crore villa. If I vote to declare a 5 crore dividend, I take the money, but I immediately owe the government over 30% in taxes based on my slab rate. I lose almost 2 crores to the taxman.
Exactly. So
Yeah.
your accountant gets creative. They say, don't declare a dividend. Just have the company issue you a 5 crore loan. You sign a piece of paper saying you'll pay it back eventually. Loans aren't income, they're liabilities. You get the 5 crores tax-free.
Wow.
Historically, founders would do this, perpetually roll the loan over, never actually pay it back, and effectively enjoy the company's profits without ever paying personal income tax.
And Condition E is the sledgehammer that destroys that strategy.
The ultimate sledgehammer. The tax officer audits the company, sees the 5 crore advance to the controlling shareholder, checks that the company has accumulated profits, and invokes Section 222E. They instantly reclassify that 5 crore loan as a deemed dividend in your hands. You don't get to argue that you intend to pay it back. You are taxed on the 5 crores immediately under income from other sources.
That is brutal, but entirely fair when you look at the economic reality. And finally, Condition F.
Condition F is the payment made by a company on buyback of its own shares from a shareholder in accordance with the Companies Act.
Okay, buybacks. This is a massive topic. I know the rules around how dividends and buybacks are taxed have been a roller coaster over the last few years. The text has a whole scheme of taxation section that reads like a history book. Can we map out this timeline? Because I know examiners love testing the timeline.
They absolutely do. They will try to confuse you with the rules from 5 years ago versus the rules today. Let's break this down into 3 distinct eras. Flag this chronology for the exam. Era number 1 is the historical baseline, up to assessment year 2020-21. During this period, India operated under the dividend distribution tax, or DDT, regime.
How did the DDT work mechanically?
It was essentially a tax collected at the source of the wealth. If a domestic company declared a dividend, the company itself was liable to pay the DDT straight to the government before the money ever left the corporate accounts. Because the company had already paid the tax on that specific pool of money, the shareholder who received the dividend generally got it entirely tax-exempt.
From the government's perspective, that seems incredibly efficient. You only have to audit a few thousand companies instead of millions of individual retail investors to collect the tax. Why did they abolish it?
It was efficient, but it was fundamentally inequitable. The DDT was applied at a flat, relatively high rate, often hovering around 15 to 20% effective. Think about a retired pensioner whose total income is well below the taxable threshold. They shouldn't be paying any income tax.
Right.
But because the company paid the DDT before handing them their dividend, that pensioner was effectively suffering a 20% tax hit on their investment income. On the flip side, ultra-high net worth individuals in the 30% or 42% brackets were getting a massive discount because the dividend was tax-free in their hands after the company paid the lower DDP rate.
Ah, it broke the progressive tax system. So that brings us to era number 2.
Yes. From assessment year 2021-22 onwards, the Finance Act completely abolished the DDT. They shifted the entire burden from the company back to the investor. Now, the system is clean. The company pays out the gross dividend, and that dividend is fully taxable directly in the hands of the shareholder. It gets dropped into the income from other sources bucket and is taxed at whatever your applicable slab rate is.
So the pensioner pays 0% because they are under the threshold, and the billionaire pays their top marginal rate. That makes mathematical sense. Now, the text mentions something about residential status here. Does a foreign investor pay the same way?
It gets more complex for non-residents. Their taxability is subject to international treaties, specifically the provisions of double taxation avoidance agreements, or DTAAs, and the multilateral instrument, MLI.
Let's do an ELI 5 explain. I'm 5 for those acronyms.
Imagine an investor lives in Germany but owns shares in an Indian company. The Indian company pays a dividend. India wants to tax it because the money was generated here. Germany wants to tax it because the investor lives there. A DTAA is a treaty between India and Germany that dictates exactly who gets to tax what and at what maximum rate, so the investor doesn't get crushed by paying full taxes to both governments.
Okay, makes sense. What about MLI?
The MLI is essentially a massive global mega treaty that updates thousands of these bilateral DTAs all at once to prevent tax evasion. But for a domestic retail investor sitting in Mumbai or Delhi, you ignore all that. The dividend simply adds to your total income.
Okay, so era 1 was company pays DDT, era 2 is shareholder pays slab rate. Is there a third era?
Yes, and this is the trapdoor for your exam. Era 3 begins with a highly specific, very recent date, with effect from 1st October 2024. This entirely overhauled the taxation of buybacks. Flag this date.
Let's define a buyback first, just to be clear, is when a company takes its own cash and buys its own shares back from the public market, effectively reducing the number of shares outstanding. Historically, companies loved doing this instead of paying dividends, right?
Exactly. Historically, buybacks were often structured or taxed in ways that resulted in lower effective tax rates for investors compared to receiving straight dividends, usually being taxed as capital gains. The government decided to completely close this arbitrage. The new rule from October 1st, 2024 dictates that buyback proceeds received by a shareholder shall be taxed entirely as a dividend under the head income from other sources.
Okay, let me build a mathematical scenario to make sure I grasp the sheer magnitude of this change. Let's say 5 years ago, I bought shares of a company, let's call it Tech Corp. My cost of acquisition, the money I actually spent to buy the shares, was 300 rupees per share.
Okay.
TechCorp has a great year, and in November 2024, they announce a buyback at 400 rupees per share. I surrender my shares to the company. You are saying the entire 400 rupees is treated as a dividend.
Yes. The entire 400 rupee cash inflow hits your bank account and is instantly classified as dividend income under other sources. And here's the kicker explicitly stated in the text. No deduction for expenses shall be available from such dividend while determining the income from other sources.
Wait, that sounds insane. I spent 300 rupees of my own after-tax money to buy that share. If I sell it on the open market for 400, I only pay capital gains tax on the 100 profit. But if I surrender it in the buyback, you're telling me I pay tax on the full 400? I can't deduct my initial 300 investment.
You cannot deduct it from the dividend income. The law is absolute on this. But don't panic, your 300 rupees hasn't evaporated into thin air. The government didn't steal your cost basis, they just forced it into a different bucket.
Okay, explain the mechanism. Where does my 300 go?
The text clarifies this beautifully. It states that the cost of acquisition of the shares which are bought back by the company, your 300 rupees, will be treated as a capital loss in the hands of the shareholder.
A capital loss. But I made money on the trade. I bought at 300 and got 400.
Not according to the new tax architecture. You see, the government is conceptually splitting the transaction in half. Transaction A. The company handed you 400 of accumulated profits. That's a dividend. Transaction B. You relinquished a capital asset, the share to the company. And because Transaction A already accounted for all the cash, you effectively received zero consideration for the capital asset itself. Therefore, you relinquished an asset worth 300 for zero return. That generates a 300 capital loss.
Oh, wow. Okay, that is a wild conceptual separation. So on my tax return, my other sources income goes up by 400, driving up my tax bill there. But simultaneously, my capital gains schedule logs the 300 loss. What can I do with that loss?
You utilize it just like any other capital loss under the existing tax framework.
Yeah.
You can set it off against other capital gains you might have in the same year, say you sold some property or other stocks at a profit. If you don't have enough gains this year, you can carry that 300 capital loss forward to future years to offset future gains, subject to the standard time limits.
This dramatically changes the math for retail investors deciding whether to participate in a buyback. If I don't have any capital gains to offset, I'm just taking a massive upfront tax hit on the gross amount.
Precisely. It makes buybacks far less attractive as a pure cash extraction method unless you have a carefully managed portfolio with offsetting gains. And for the exam, this is absolute gold for the examiners. They will give you the 300 cost, the 400 buyback price, and ask you to compute the income from other sources. If you answer 100, you fail. The answer is 400. Flag that scenario.
I am writing buyback gross equals dividend in huge letters in my notes. Are there any administrative mechanisms I need to worry about here? How does the government track all these dividends hitting my account?
Through tax deducted at source, or TDS. A quick exam flag to remember. Tax is required to be deducted at source from dividends by the company in accordance with Section 194 or Section 194K of the Income Tax Act, depending on the specifics. So the company withholds a percentage and sends it to the government linked to your PAN card, ensuring you can't just forget to declare it.
Section 194 and 194K. Got it. Okay. If we zoom out and look at the broader financial landscape, dividends are the mechanism for rewarding equity holders, the owners. We've mapped out that terrain. But what about the reward for debt holders, the lenders? Let's cross the bridge into Section 9.3, decoding interest on securities.
It is a perfect structural transition. If you decide not to buy a piece of the company, but rather loan them your money, you earn interest. And just as the Income Tax Act meticulously defined dividends, it has highly specific guardrails for what constitutes interest on securities.
Let's start with the foundational textbook definition. What is the legal scope?
The definition is rooted in Section 228B of the Income Tax Act. It casts a very specific net. It states that interest on securities means two main things. First, interest on any security of the central government or state government. Second, interest on debentures or other securities for money issued by or on behalf of a local authority or a company or a corporation established by a central, state, or provincial act.
Okay, so if I buy a sovereign gold bond from the central government, or a municipal bond from the Mumbai civic body, or a corporate debenture from Tata Motors, the interest from all of those falls here. But the phrase securities for money feels a bit ambiguous. Does the Income Tax Act actually define what a security is?
This is a fascinating quirk of Indian corporate law. The Income Tax Act, for all its thousands of pages, actually does not define the word security itself. When it needs a definition, it essentially borrows it from a completely different piece of legislation.
Oh, really? Which one?
The text explicitly tells us that securities will have the meaning assigned to it in Section 2 of the Securities Contracts Regulation Act 1956. We often just call this the SCRA.
I've seen SCRA referenced in other modules, so we are importing a definition. What does the SCRA say? What are the specific instruments we need to know for the exam?
Based on the SCRA definition, the text highlights 5 specific categories of instruments that generate this type of interest. You must be able to recognize all 5. Category A bonds, Category B debentures or debenture stock, Category C security receipts, Category D government securities, and Category E pooled investment vehicles.
Bonds, debentures, government securities, those are the standard debt market staples. What exactly is a pooled investment vehicle in this context?
Think of alternative investment funds, or AIFs, or certain mutual fund structures that pool money from multiple investors to buy a massive portfolio of debt instruments. The interest generated by that underlying portfolio and passed back to you is covered under this broad SCRA definition.
Okay, so I've bought the bond. I know it fits the definition. Now the practical question. When do I actually owe the tax? Let's say I own a corporate bond that pays interest annually on December 31st. But the company is facing a cash crunch and says, we owe you the interest, but we can't pay you until March. Do I report the income in December when I earned it, or in March when the cash actually hits my bank account?
That is the multi-million-dollar question of accounting. And it brings us to the basis of charge under Section 145 of the Income Tax Act. The answer is, it depends entirely on the accounting method you have chosen to adopt. The Act allows taxpayers to follow one of 2 methods of accounting for this head of income, provided they use it regularly and consistently. Method 1 is the mercantile system. Method 2 is the cash system.
Let's define the mercantile system first.
The mercantile system is essentially accrual-based accounting. If an assessee follows this system, the interest on securities is taxable when it accrues or becomes due, regardless of whether you have actually received the cash.
So in my scenario, the interest was due on December 31st. Even if the company hasn't paid me a single rupee, I have to declare that income on my tax return and pay the government tax out of my own pocket.
Exactly. You acquired the legal right to receive the money, so the income has accrued. You pay the tax now.
That feels harsh if the company eventually defaults. What about the cash system?
If the assessee follows the cash system, the income is taxable strictly on a receipt basis. You only recognize the income and therefore only pay tax on it in the financial year when the physical cash actually hits your bank account. If the company delays payment until March of the next year, the tax liability is pushed to that next year.
Well, if I have a choice, why wouldn't I always just pick the cash system? Or better yet, why couldn't I just tell the bond issuer, hey, don't pay me my interest this year because I have a high salary, hold on to it and pay it to me in 3 years when I retire and my tax bracket drops? Can I just game the system by delaying receipt?
The tax department is way ahead of you. Remember the caveat I mentioned, provided you use it regularly. You cannot switch your accounting method year to year to game your tax brackets. If you declare you are using the cash method, you must apply it consistently to all your income under this head.
Ah, I see.
Furthermore, if the tax officer believes your arrangement with the company to artificially defer payment is a sham transaction designed purely to evade taxes, they have anti-avoidance rules to strike it down. The system must reflect commercial reality.
Okay, fair enough. Consistency is key. Now, let's go back to the visualization exercise we did for the broad other sources category. How do I precisely compute my taxable interest income? What does the ledger look like?
I want you to visualize a 3-line tax computation table, specifically designed for Section 9.11. Line 1 at the very top is your gross interest from securities. This is the total, unadjusted, raw amount of interest you earned or accrued.
Okay, line 1 is the gross number. What is line 2?
Line 2 is titled Less Permissible Deductions. Just like a business can deduct the cost of goods sold, you don't have to pay tax on the gross interest if you incurred legitimate direct expenses to earn it. The text meticulously lists 3 specific permissible deductions under this line. First, collection charges.
What does a collection charge look like for a retail investor?
It used to be much more common when physical coupons had to be clipped from bonds and presented to a bank. The bank would charge a fee to process the coupon and collect the cash from the issuer. Today, it might be a specific depository or custodial fee charged by your broker, specifically related to the realization of that bond interest. If the bank charges you 50 rupees to process a 10,000 rupee interest payment, your taxable income is 9,950.
A small but fair deduction. What is the second one?
This is the most strategically important deduction. Interest on borrowings obtained to purchase securities.
Let me make sure I understand the leverage aspect here. Let's say I believe a corporate bond paying 10% is a great investment, but I don't have cash. So I take a personal loan from my bank at 8% interest, and I use that borrowed money to buy the 10% bonds.
A classic carry trade.
Right. So I earn 10% from the company, but I pay 8% to the bank. Are you saying I only pay income tax on the 2% spread?
That is exactly what I'm saying. You declare the gross 10% on line 1. On line 2, you deduct the 8% interest you paid on the borrowed funds. Your final taxable income on line 3 is just the net 2% profit. The critical requirement is that you must be able to prove a direct, undeniable nexus between the borrowed funds and the purchase of the securities. You can't just deduct your home loan interest against your bond income. The loan must have been obtained to purchase those specific securities.
That makes leverage significantly more tax efficient. What is the third permissible deduction?
The third is a general catch-all. Any other revenue expenditure laid out or expended wholly and exclusively for the purpose of earning such income. This covers legitimate, recurring administrative expenses directly tied to managing those specific securities, perhaps fees paid to a portfolio manager specifically for the debt portion of your portfolio. Notice it says revenue expenditure. You cannot deduct capital expenses, like the cost of buying a laptop to track your investments.
So line 1, which is gross interest, minus line 2, permissible deductions, equals line 3, my final taxable income from securities. Now, I have a theoretical pushback here, and I think it's where a lot of people get confused between the different heads of income. Let's say I buy a 10-year government bond. My primary goal is to hold it and collect the annual interest. Based on everything we just discussed, that annual interest goes into the other sources drawer. But let's say 3 years later, overall interest rates in the economy plummet. Because of the inverse relationship between yield and price, the market value of my bond skyrockets.
Very common scenario.
Right. And I decide I don't want the annual interest anymore. I want to cash in on the price surge. I sell the bond on the open market for a massive profit. Where does that profit go? Is the profit from the sale also other sources?
This is a classic conceptual trap, and the NISM examiners will absolutely test your understanding of this boundary, flag this. The text addresses it directly under the heading taxability of income. You have to conceptually separate the yield of the asset from the asset itself.
The golden goose versus the golden eggs.
Exactly. The golden eggs, the periodic interest payments, are the yield. The yield is always, unconditionally, income from other sources. But what happens when you sell the golden goose itself? The tax treatment of that sale profit depends entirely on how you categorize the bond in your books when you bought it.
Categorized it how? What are the options?
There are two main options. Option 1. The securities are held as stock in trade. This means you are a dealer. You are actively buying and selling bonds on a daily or weekly basis as your primary business activity, trying to capture small price movements.
Like an institutional bond trader or a specialized proprietary trading firm.
Yes. If you hold them as stock in trade, then any profit arising from the sale of those securities is chargeable to tax under the head profits and gains from business or profession. It's your business inventory.
But I'm not a dealer. I'm just a retail investor. I bought it, held it for 3 years, and sold it opportunistically.
Then you fall into option 2. If the securities are held as an investment, which is the default assumption for retail investors, then the bond is a capital asset. Any profit arising from the sale of that capital asset is chargeable to tax under the head capital gains. You would calculate your purchase price, maybe apply indexation if it's applicable based on the current rules, and pay capital gains tax.
Okay, that is an incredibly clear framework. Yield equals other sources. Sale of the asset itself equals capital gains or business income, depending on your motive. Now, I have one more curveball for the interest section. We've assumed everything is in Indian rupees. But what if I am a sophisticated investor and I've bought U.S. Treasury bonds or European corporate debt?
Or foreign currency.
Right, the interest is going to be credited to me in U.S. dollars or euros. I obviously can't file my Indian tax return in dollars. How do I convert it? Do I just look up the exchange rate on Google on the day I sit down to file my taxes in July?
Absolutely not. The Income Tax Department does not rely on subjective, retroactive Google searches. Exchange rates fluctuate second by second. Allowing taxpayers to pick their conversion date would result in massive manipulation. There is a highly specific, standardized rule for this, and this is another major trapdoor for the exam.
I'm listening. What is the exact rule for converting foreign currency interest?
The rule states that if any income from securities earned in foreign currency is taxable in India, it shall be converted into Indian rupees using the SBI telegraphic transfer buying rate.
Okay, the State Bank of India's TT buying rate. That gives us a standardized source, but the timing is the issue. Which day's rate do I use?
This is the critical phrase you must memorize and flag it. Use the SBI telegraphic transfer buying rate that exists on the last day of the month, immediately preceding the month in which the income is due.
Wait, let me map that out on a calendar to make sure I understand. Let's say my US dollar bond pays coupon interest semi-annually, and the next payment is due on November 15th. I don't use the exchange rate from November 15th when I received it. I have to go backwards.
You have to go backwards. The income is due in November. The month immediately preceding November is October. The last day of that preceding month is October 31st. Therefore, you must use the SBI rate as it stood on October 31st to convert your November 15th interest payment.
That is highly counterintuitive. Why would the government design it that way? Why not just use the rate on the day I get the money?
It's designed for absolute predictability and to prevent intra-month manipulation. By anchoring the rate to the end of the prior month, both the taxpayer and the government know the exact, indisputable conversion rate before the transaction month even begins. It removes all ambiguity.
Yeah.
If you receive 3 different interest payments on November 5th, 15th, and 28th, you use the exact same October 31st rate for all of them. It radically simplifies the accounting.
That actually makes a lot of administrative sense. Is there any exception to this prior month rule?
The text mentions one specific exception. If the income payable in foreign currency is subject to TDS, in that specific scenario, the date of conversion will be the date on which the tax is required to be deducted. But for general, untaxed at source foreign interest, the standard rule is that prior month-end SBI rate.
Okay, I feel incredibly solid on interest and dividends now. We have thoroughly covered the income you earn from participating in the markets, the profits from equity, the yield from debt. But let's pivot and look at a scenario where you bypass the financial markets entirely. What happens if someone doesn't sell me shares but just gives them to me for free? Let's move to Section 9.4, Gift of Securities.
This is where the miscellaneous drawer gets fascinating, because it intersects with human relationships. The tax department is acutely aware that if gifts were entirely tax-free, nobody would ever sell anything. They would just gift assets and gift cash back in return to avoid capital gains. So, they have heavily regulated gifts under other sources to plug those loopholes.
What is the foundational rule that sets the stage here?
The foundational rule is that where any person receives a movable property from any person without consideration, which is legal jargon for free, or for inadequate consideration, meaning at a massive non-commercial discount, then the value of that property shall be chargeable to tax in the hands of the recipient as income from other sources.
So the burden is on the person receiving the gift, not the person giving it. But surely they aren't taxing every little thing. If a friend buys me a novel worth 500 rupees for my birthday, I don't have to declare that on my tax return, right?
Right. The administrative burden of tracking 500 rupee gifts would be absurd. So there is a threshold. And this is a threshold you must memorize. Flag this limit. The limit is 50,000 rupees. The law states that no tax shall be charged if the aggregate amount of difference between the fair market value of properties received during the year and the amount of consideration paid does not exceed 50,000 rupees.
And securities count as movable property.
Yes, the text explicitly confirms that movable property for the purpose of this provision includes shares and securities.
Okay, 50,000 rupees aggregate per year. Let's run a computation scenario to see how the math actually works, because I feel a trapdoor coming. Let's say my friend gifts me a block of unlisted shares. The fair market value, or FMV, of these shares is calculated to be 60,000 rupees. He transfers them to me entirely for free. Since the safe limit is 50,000, do I just declare the 10,000 rupee overage as other sources and pay tax on that?
I am so glad you asked that, because this is unequivocally the #1 mistake students make on the NISM computation questions. It's a massive trapdoor. The text is incredibly specific here in section 9.4.1. It says, where shares are received without consideration, the whole of the aggregate fair market value shall be chargeable to tax, IFF. The aggregate fair market value exceeds 50,000 rupees.
Wait, let me process that. The whole amount. So in my scenario, where the FMV is 60K, I don't pay tax on a 10K overage. I pay tax on the full 60K.
Emphatically, yes. The entire 60,000 rupees becomes taxable under income from other sources. The 50,000 limit is not a standard deduction that you get to subtract from every gift. It is a cliff-edge trigger threshold. If your aggregate gifts for the year total 49,999 rupees, your tax is 0. If you receive 1 more rupee and hit 50,001, your taxable income instantly jumps to 50,001.
That is a brutal cliff edge. The difference of 1 rupee in the gift value changes the taxable amount from 0 to 50,000. That seems incredibly harsh.
It is harsh, but it's designed to be a hard barrier against systematic tax evasion through small incremental gifting. Now, what if you didn't get the shares for free, but you just bought them really cheap? Let's say the FMV of a block of shares is 1,000 rupees, but your friend sells them to you for just 40,000 rupees.
Okay, so I paid something, but it's clearly a sweetheart deal.
That's the definition of inadequate consideration. In that case, the law looks at the difference between the FMV, the 1,000, and the consideration you actually paid, the 40,000. The difference is 60,000. Because that 60,000 difference exceeds the 50,000 trigger threshold, that entire 60,000 difference is taxable in your hands as other sources.
The mechanics are ruthless. Just as a quick side note, how exactly is fair market value determined? If it's a publicly traded stock like Tata Motors, it's easy, you just look at the ticker. But what if it's shares in my friend's private startup?
The text provides the regulatory anchor for this. Section 9.4.2 states that the fair market value of shares and securities is computed as per Rule 11 UA of the Income Tax Rules, 1962. Rule 11 UA is a complex, distinct set of valuation guidelines that prescribes very specific mathematical methods for valuing unquoted equity shares, often involving the company's book value or discounted cash flows.
Do we need to memorize the formulas?
You don't need to memorize the formulas of 11 UA for this chapter, but you absolutely need to know that 11 UA is the rule that governs the valuation. Flag the rule name.
Rule 11 UA. Noted. Now, let's step back and look at the cultural context. Indian culture is built around extended families, and intergenerational gifting is massive. Weddings, births, festivals, wealth is constantly moving. Surely the tax department doesn't tax a father giving his life savings and shares to his daughter. There has to be a safe list, a sanctuary from this 50K cliff edge.
There is a very extensive sanctuary. The government recognized that taxing genuine familial or circumstantial gifts would be socially disastrous. Section 9.4.3 outlines cases when income is not chargeable to tax.
Yep.
If your receipt falls under these specific exemptions, you can receive shares worth 10 million rupees for free, and zero tax will be charged under this provision.
Okay.
The text divides these exemptions into two main categories: exemptions due to a specified event and exemptions due to the status of donor or payer.
Let's explore the specified events first. What are the life events where the taxman effectively looks the other way?
The text lists three specific, highly protected events where a gift tax shall not arise. First, on the occasion of the marriage of the individual.
So wedding gifts are completely exempt, no matter how large. That aligns perfectly with Indian cultural norms.
Yes, but note the precision of the language. Marriage of the individual. If you get married, the gifts you receive are tax-free. If it is your parents' anniversary or your child's birthday, those gifts are not protected by this specific clause.
Ah, very specific. What is the second event?
Second, under a will or by way of inheritance. The generational transfer of wealth upon death is not taxed under income from other sources. And the third event is very closely related, in contemplation of death of the payer or donor.
So deathbed gifts, where someone might not have a formal will but distributes their assets in their final days, are also protected. Okay, so weddings and death are the two protected life events. What about the other category, the status of donor exemptions?
These apply regardless of what day it is. Even if it's just a random Tuesday, gifts received from certain entities or people are completely exempt. The list includes A, from any specified relative, B, from any local authority, C, from any fund, foundation, university, educational institution, hospital, medical institution, or trust referred to in Section 1023C.
Okay, local authorities and specific recognized medical or educational charities under 1023C. That makes sense.
It continues. D, from any trust or institution registered under Section 12A, 12AAA, or 12AB, these are the primary sections governing registered charitable organizations, and E, from an individual by a trust created or established solely for the benefit of relative of such individual.
So legitimate charities and specific family trusts are safe. But the biggest and most important item on that list for a retail investor is the very first one, from any specified relative. This is the core of family wealth planning. But how does the tax code define a relative? In India, we call everyone uncle or aunt. If I'm mapping this out, I'm visualizing a massive, chaotic Indian wedding reception. Who actually gets onto the tax-free invite list?
It is exactly like planning a wedding guest list, except the income tax department is the strictest, most pedantic wedding planner imaginable. The biological and legal links must be precise. For an individual taxpayer, the text provides a comprehensive multi-row table defining exactly who is treated as a relative. We're going to do a meticulous walkthrough of this entire family tree, row by row. As a student, you need to know exactly who is on this list and more importantly, who is left standing outside the gates.
I am ready. Let's map out the tax-free family tree.
Row 1 is the immediate core, husband or wife. Spousal gifts are entirely tax-free. Row 2 moves downwards, son or daughter. And the text explicitly states this includes stepchild and adopted child. And on the other side of that same generational row, daughter-in-law and son-in-law.
So direct descendants and the people they marry are fully integrated and safe. Next.
Row 3 moves upwards, father and mother, which explicitly includes stepfather and stepmother, and their counterparts, mother-in-law and father-in-law.
Direct descendants and the spouse's parents. Check.
Row 4 expands horizontally. This is where it gets wide. Brother and his wife, sister and her husband. And this row explicitly includes half-brother and half-sister. On the spouse's side, brother-in-law and his wife, and sister-in-law and her husband.
Okay, so all my siblings, my half-siblings, my spouse's siblings, and all of their respective spouses, that covers a massive amount of the typical family structure.
It does. Row 5 moves up another generation, grandfather and grandmother, and the spouse's grandfather and spouse's grandmother. Row 6 moves down a generation, grandson and his wife, granddaughter and her husband, and it goes even further down to great-grandson and his wife, great-granddaughter and her husband.
So the vertical lines, lineal ascendants and descendants, extend basically forever and always include the spouses.
Exactly. Row 7 confirms that by moving up again. Great-grandfather and great-grandmother, plus the spouse's great-grandfather and spouse's great-grandmother.
Okay, we've exhaustively covered the vertical lines and my immediate horizontal siblings. But what about the extended family? The aunts and uncles. That's the backbone of the Indian family network.
That is addressed in the final row in the table, row 8, and it is highly specific. The tax code distinguishes between the paternal and maternal sides. On the paternal side, father's brother, meaning your chacha or tau, and his wife, father's sister, your bua, and her husband.
Okay, my dad's brothers and sisters and their spouses.
And on the maternal side, mother's brother, your mama and his wife, mother's sister, your mausi, and her husband.
Wow. That is an incredibly exhaustive and culturally attuned list. So if my mother's brother decides to gift me shares worth 10 lakh rupees on a random Tuesday, it is completely tax-free under other sources because he is a legally defined relative.
That is correct. But here's the absolute most critical part of this entire section. You notice how specific and detailed that list was. When the NISM examiners write questions on this topic, they rarely test you on who is on the list. They test you on who is not on the list. I need you to flag the exclusions.
Okay, paying close attention.
The text specifically highlights certain people who are not deemed as relatives for this provision. Meaning, if you receive a gift from them that exceeds 50K, it is fully taxable.
Okay, this is where people lose marks. Who got left off the wedding invite list? Let's identify the trapdoors.
There are 3 specific categories of exclusions you must flag. Number 1, stepbrother or stepsister.
Wait, really? Let me check my notes on row 4. Ah, look at that nuance. Half-brothers and half-sisters were explicitly on the safe list, but step-siblings are not. That is a devious little distinction by the tax department.
It is incredibly precise. A half-sibling shares 1 biological parent with you. A step-sibling shares 0 biological parents with you. The link is purely through a parent's subsequent marriage. The tax code draws a hard biological line there. Half-siblings are relatives. Step-siblings are strangers for tax purposes. Number 2 on the excluded list, nephews and nieces.
Let me puzzle through this one. My father's brother, my uncle, is on the list, so my uncle can give me a tax-free gift. But my uncle's son, wait, no, let's look at it from the other direction. I can receive a tax-free gift from my uncle, but if I give a gift to my nephew, is it taxable?
Let's trace the logic exactly as the text lays it out, because this asymmetry confuses everyone. The text defines relative strictly from the perspective of the recipient of the gift.
Okay, recipient's perspective.
If you receive a gift from your uncle, the tax man looks at your list of relatives.
Yes.
Is father's brother on your list? Yes. The gift is tax-free. Now reverse the flow. If your uncle receives a gift from you, the tax man looks at his list of relatives. You are his brother's son, his nephew. His brother's son on his list of relatives.
No, lineal descendants are on the list, but not the siblings' descendants.
Exactly. Nephews and nieces are not on the recipient's relative list. Therefore, a gift from a nephew to an uncle is fully taxable in the uncle's hands. The relationship is legally defined as non-symmetrical. It only flows one-way tax-free.
That is mind-bending, but perfectly logically consistent if you strictly follow the table. Recipient's perspective only. Okay, so step-siblings are excluded, nephews and nieces are excluded. Who is the third excluded category?
Number 3.
Cousins.
Cousins. The classic Indian family dynamic. We grew up together, we call them our brothers and sisters, but the tax department emphatically does not.
Exactly. Biologically and legally, the line stops at your parent siblings. It does not extend down to their children. Gifts from cousins, if the aggregate exceeds 50,000 rupees, are fully taxable as income from other sources, period. So remember those three major exclusions to navigate the exam questions: step-siblings, nephews, nieces, and cousins.
Got those heavily flagged. Now, there was one quick note about HUFs in the text regarding relatives and gifts. I know Hindu undivided families have a unique status in Indian tax law. Yes, the HUF is treated as a separate tax entity. The text states that in the case of a Hindu undivided family, every member of the HUF will be treated as a relative for the purpose of this gifting provision. This means intra-HUF gifts transfers of wealth among the members of the family unit have a very broad safe harbor and don't trigger the 50K limit tax.
That makes sense, as the assets are essentially communal within that structure. And speaking of HUFs, there is one final exemption listed right at the end of the chapter under section 9.4.4, due to transactions not regarded as transfer. What is this referring to?
This is a structural exemption. Income shall not arise under this gifting provision if any sum of money or property is received via any distribution of capital assets on the total or partial partition of a HUF under Section 47I.
So if a large joint family decides to officially split up and partition the ancestral estate, the members receiving those huge chunks of assets aren't suddenly hit with an other source's tax bill.
Correct. The partition of the family estate is not viewed as a gift from one person to another. It is the legal distribution of pre-existing rights. Therefore, it bypasses the other source's net entirely.
Okay, taking a deep breath here. We have covered an immense amount of conceptual and highly technical ground. I genuinely feel like I understand the architecture of Chapter 9 now, not just the bullet points.
It is a lot, but let's do a final structural recap to cement the journey.
Okay. We started by identifying the fundamental nature of the residuary head, the highly regulated miscellaneous drawer. We meticulously walked through the 14-point list of what goes in there, exploring the logic behind taxing lottery windfalls, the nuances of renting machinery as a side hustle, and why the government taxes forfeited advance money to prevent wealth transfer loopholes.
Correct. And we identified the 5 items that unconditionally bypass the business gauntlet and land straight in this drawer, led by dividends.
Right. We then did a massive deep dive on dividends. We broke down the substance over form doctrine of deemed dividends, highlighting the specific trap of closely held company loans to founders. We traced the historical timeline from the DDT era to the modern slab rate era. And most importantly, we mathematically dissected the October 2024 buyback rule, changed the fact that the gross buyback amount is fully taxable as dividend, and the original cost basis is shifted to a capital loss.
That is the most critical contemporary update in the module.
From there, we decoded the rewards of debt, interest on securities, we clarified the SCRA definitions, debated the commercial reality of mercantile versus cash accounting, and built the 3-line computation table. We made the vital distinction between taxing the yield, which is other sources, versus taxing the sale of the asset itself, which is capital gains or business. And we learned the highly specific rule for converting foreign currency using the SBI rate from the last day of the preceding month.
And finally, we navigated the minefield of gifting.
Yes, the 50K cliff edge threshold where the entire amount becomes taxable. We explored Rule 11 UA for valuation, and we painstakingly mapped out the tax-free family tree. We identified the protected life events like weddings and inheritance, and we highlighted the major exam trapdoors by explicitly excluding step-siblings, nephews, nieces, and cousins from the safe list.
That is an exceptional, comprehensive summary. You have the structural framework and the microscopic details locked in perfectly. As your mentor for this certification, my final piece of exam strategy advice is to trust the logic we've built. The NISM examiners are not trying to trick you with unanswerable paradoxes. They are testing your mastery of the boundaries. They will test the 50,000 aggregate limit, specifically that cliff edge computation. They will test the asymmetry of the non-relative list. They will test the specific dates and mechanics of the buyback changes. Review the scenarios we debated today. Trust the framework, and you will absolutely ace this section of the certification.
I really appreciate that. It brings so much clarity to the muddy waters we started in. And as we wrap up, I can't help but think about the future of this specific income from other sources bucket. It feels like the most dynamic part of the tax code.
It absolutely is. It's a living mechanism. What are you seeing on the horizon?
Well, financial markets and human ingenuity are evolving faster than the legislative tax code can usually keep up. We are seeing entirely new, uncategorized financial assets being invented globally every single day. Look at the rise of niche digital tokens, fractionalized virtual real estate in the metaverse, decentralized finance staking rewards, or algorithmic yield farming. Right now, a lot of those novel wealth generation mechanisms don't fit neatly into the traditional definitions of salary, house property, or even standard business income. This miscellaneous drawer, this residuary head we spent the last hour dissecting, is only going to get wider, deeper, and infinitely more complex in the coming decades as the economy digitizes.
That is a profoundly insightful thought to end on. The fundamental nature of property, yield, and income is expanding rapidly. The specific assets will change, but the government's mandate to tax the accretion of wealth will not. If you truly understand the foundational logic of Chapter 9 that we explored today, why the government categorizes things the way it does, how it isolates the yield from the underlying asset, how it structurally prevents tax evasion loopholes, you won't just pass your NISM exam tomorrow.
Yeah.
You will be equipped with the analytical tools to classify, understand, and navigate the tax implications of the financial assets of the future, whatever bizarre forms they might take.
That is the ultimate goal, not just memorization, but mastery of the system. Thank you to everyone tuning in and doing this deep dive alongside us today. Review those specific scenarios, keep that precise family tree handy, and go conquer that certification.